You're listening to Investify, preaching financial independence and assisting investors to achieve a more flexible and free lifestyle through smart financial planning and real estate investing. If leaving the corporate world and jumping into this thriving industry is what you desire, tune in and listen to stories of like-minded individuals who made the leap to financial independence. Equip yourself with the right tips and tricks to start your real estate journey, making active or passive ventures that are highly profitable and rewarding. Here are your hosts, Craig Curelop and Zeona McIntyre.
What's going on, everyone? You are listening to Investify. My name is Craig Curelop, aka the Fi Guy, and I'm here with Z Money. How you doing?
I'm great. It's all good. You forget
your name. Yeah, your name doesn't really matter, right? Z Money is your new name. We're gonna change it. We're gonna go to the doctors, and is it the doctors you go to change your name?
It's definitely not the doctors, but our guest today is a doctor,
yes,
which is pretty funny.
Our guest today is a doctor, and he's going to shed some really good information. If you're a physician or know anyone that's a physician or want to get a physician like into financial independence, I think Chris has got an amazing story of battling the haters. He's got a great story of getting started into real estate, and he made an interesting switch from going into real estate to going into stocks. So I thought that was quite interesting. What did you think, Z?
Yeah, I think that is an interesting step, because usually it's the other way around, that people do stocks and then they get into real estate and realize they like it better. But I always like seeing how people have different paths. I really like Chris' story. He has a lot of experience. He was so fortunate to buy at really the best time and continue to buy throughout that period. He's created really impressive cash flow for himself. And I think in his story, he really talks about having to be brave and overcoming a lot of naysayers in his community and his family. And so, yeah, I think a lot of that was really inspiring.
Yeah, and I think this is like another reason why I love how we do this show, Z. It's just because it just really shows you that everybody's story is different, right? And there's not one way to hit financial independence. There's lots of different ways. And so I think Chris offers a unique take. So let's bring him on. Chris Loo, welcome to the show, my friend. How you doing today?
I'm doing well. Thanks for having me.
Yeah, thanks for coming on. You got a fancy background there, but I can tell it's fake because your microphone is hanging in air. So, Chris, thanks so much for coming on the show. We've been looking forward to having you on. Why don't you tell us a little bit about where you started in your financial independence journey? Where did you first hear about financial independence?
Sure. Well, I first heard about financial independence in 2002. And what was interesting was I'm born on the cusp of Gen X and millennials. So back then, really, finances were really important, but the predominant way of thinking about financial independence was through a safe, high-paying, secure job. So, my parents, first-generation immigrants, so they pushed me and my brother to become doctors and physicians. So at that time, that's what I really excelled at and pursued at. So I went into the medical profession, and it was interesting because 2001, I was a medical student, and all of a sudden the planes hit the World Trade Center, September 11th. And then a lot of my friends, they opted to, right out of graduation, work for Wall Street and Silicon Valley. And so right after that, I saw a lot of them get let go. So that was my first wake-up call as to why a job is not very secure in today's society. So that's when I came upon the book Rich Dad Poor Dad, and that was in 2002. And I started from there. I read that, and then I read Multiple Streams of Income, which is talking about diversifying your passive income streams. And from there, it just exploded. I started investing in real estate, started investing in stocks and equities. And what's interesting was I was sharing to the audience that it was September 2008. That was the next crisis, and I was a physician in training in my orthopedic residency training. And I was just miserable. I hated my job. I was so unhappy. And so I took a leap of faith and I quit my soul-sucking physician career, and I set out to become an entrepreneur. And so I was telling you guys earlier that I became a millionaire through real estate, and I became financially free 8 years later through stocks and equities. So that's my story in a nutshell, and I'm happy to answer your questions.
Great, Chris. I wanted to just kind of ask, it's interesting. We hear these stories a lot from people of a certain age or from certain backgrounds that their parents are really pushing them to be doctors and lawyers, right? Mm-hmm. But you're lucky you had the aptitude for that. What happens? Have you seen people that are not necessarily science-based, or like, how does that work? Is it just a big fail?
Yeah, it's a good question because, coming from my background, really what school you went to, where you got your undergraduate degree, what degrees you have and what profession you have are really touted. So, parents like to brag that their kids are, doctors, lawyers, work on Wall Street, et cetera. And really, it's not the healthiest thing in today's world, because now we have an information-based age as opposed to a industrial age. So, a lot of these careers that we're seeing today in artificial intelligence, technology, creatives, writing, authors, speaking, etc., also influencers, these are careers that we did not see 20, 30 years ago. So really, it's not the healthiest thing to really just push your kids into, say, a profession, just, for the sake of stability and job. And what's interesting is because last year really was a wake-up call to the entire world, to the entire planet. So now people are seeing, there are different options. And not only are there different options, but it's actually a lot safer to pursue one's passions, to pursue one's interest, to pursue one's calling, as opposed to just following the traditional mode of thinking.
Yeah, I think that has been a really great wake-up call, as that people are starting to say, hey, time is maybe limited. Let's do what feels important to us. But just going back into your story, it sounds like Rich Dad, Poor Dad was a catalyst for you, as it has been for many people. Was there something specific in that book that really jumped out to you and made you maybe look towards real estate?
Well, that's a good question. So the one thing that really, the key takeaway that I got away from Robert Kiyosaki from that book was that the difference between an employee and the difference between self-employed, entrepreneur, and investor. So that was the big key takeaway. And the takeaway that I realized was that the path that I was on, I was really following my parents' dreams as opposed to my own. And it was really setting me up for to be an employee. So as a physician, there's a high earned income, but you have no control over your time. You have no control over the amount of taxes that you pay, and you have no control per se over your job. So, a lot of insurance companies have these mandates. So you really have zero control. So that was the key takeaway. From there, it was interesting because I started studying all different ways. What was financial freedom? So I am the founder of the Financial Freedom for Physicians. We have a website, blog, podcast, YouTube channel, etc. And there's 4 types of freedom that I came upon. So one is financial freedom, where you don't need to trade your time for money, where you're really using your time for better uses. There's also location freedom, so you can live, work anywhere in the world. There's also emotional freedom, and there's also emotional freedom. So all of these types of freedoms compose of allow oneself to be more happier. And it's not just, in the past, it was just how much money you made, what was your net worth, and that's been shown not to really equate with happiness. So I started studying there. From there, there was 2 main key avenues that individuals became financially free, wealthy, and independent. So one was through real estate, and the second one was through stocks and equities, and the third one was starting your own business. Now, with 2020 and we have Gen Z, millennials, now there's a lot of different other ways. There's, the creative economy, there's the influencer economy, there's social media, there's blockchain technology, artificial intelligence. So,
hey, Chris, let me interrupt you here for a second. I want to just, you're unpacking a lot, right? And so I want to just kind of dive into the first thing you said about your parents wanted you to be an employee, and how impactful that square. If you haven't read Rich Dad Poor Dad, you guys got to read Rich Dad Poor Dad to know what we're talking about. But it's that square, and I know what you're talking about. It's the ESBI, right? Mm-hmm. Employer is in the top left. Self-employed is the S. B is in the top right, which is a business owner, and then I is investor. And through that square, you're basically becoming more and more passive, right? And so you want to, as a doctor, you're an employee of the hospital, or I don't even know who pays you as a doctor, but you're an employee of somebody. You're making a lot of money, but you're still trading time for money. And so how, like, your parents seemed that they had a pretty big influence on your life to become a doctor. How did you go away from their advice? And how, was that hard? Like, going into what they said, was there any pushback there?
Yeah. What's interesting, there was tons of pushback, and it was one of the points in your life where you have to really buckle down and you have to really know yourself. So I give this story all the time. Right after September 2008, I mailed my medical school diploma back to my parents. I told them that I was quitting my medical career and I wanted to do something that was more productive and more healthier. And their response was outrage and just a lot of dysfunction. And I didn't just get that from my parents, but I also got it from my colleagues, my friends, my mentors. They all thought I was crazy. I was doing something stupid. I was throwing away my future. But really, you have to really look at it you have to zoom out from the eagle eye view. So you look at it in terms of a 20, 30 or 40-year game plan. And really that one instance, you have 40, 50, 60 years for your career. And if you wanted to do something meaningful, I had to buckle down. I had to really ignore the naysayers. And I just started just executing, and I didn't tell people my plans. I just showed them the results. So since September 2008, 13 years later, they all see my progression and my success. And they say, oh, why didn't we support you back then? You could have done much better. And then, so like I said, when people look at you and you're an outsider or you're a disruptor or you're doing something different, one is either they ignore you, which is the worst type of response. The second is they'll hate on you or they'll push you down. And that's usually the fuel or the driver. And then lastly, when you make it, they'll celebrate you. So those are the three stages.
Yep. I do. I love that you just said that, because I went through those things stages too. It doesn't sound like maybe to the same extent. My parents are fairly supportive, but they were questioning, why are you doing this? Like, why are you living behind a curtain? My grandfather took me down and berated me, called me a miser, and was like, what the hell are you doing? Are you going to treat your family this way? And I was like, no, this is not like a linear path and I'm going to get cheaper and cheaper. It's like the bottom of my cheapness, and it's going to build a great foundation. So that way you can have this, like, you can live a really good life later on, right? And it sounds like you saw that. None of your friends saw that. And I just want to say, like, to the listeners out there, get ready, put on your suit of armor and get ready to get shot at and sorted at, and people are going to lash at you, the people that you love. And it's like so hard to just like push through that and just look at the numbers. That's why it's so crucial to be involved in some community where people are doing this too. So yeah, totally agree. Z, what do you think?
I'm just wondering if we really have seen the bottom of your cheapness, Craig. I feel like it's a bottomless place.
Is it a bottomless place? Maybe it is. I hope I've climbed out from that bottom of seeing behind a curtain.
Depends on the category.
Yeah, I guess so. Yeah. So, Chris, I want to commend you for that, because I think it's hard for a lot of people to see out of that. And so, just to recap, 2001, you're a doctor. 2008, you quit being a doctor, and you start getting into real estate in 2008.
I bought my first property in 2008. And from 2008 to 2016, I was buying subsequent properties. And so from there, I got my financial freedom, my financial independence. And from 2016 onwards, I've started financial freedom for physicians, trying to spread the word, get awareness. I've written 4 books. I've spoken at FinCon, major conferences, and mentored and coached the next generation.
Okay, so let's take it back to 2008, right? There's obviously a lot happening here. You're transitioning careers into real estate, among the biggest financial real estate collapse since the Great Depression. The for real deal. 2008 happens. Like, is it a house hack, or what are you doing?
I did a combination of things. So we'll get into numbers, but I did a combination of house hacking, BRRRR method, and short-term rentals, and that were the 3 main generators of my profits through real estate. So, and I think house hacking is one of the best ways of achieving financial freedom and independence. Burr method is pretty okay. And then now there's you can actually make more through short-term rentals as opposed to being a long-term landlord using Airbnb, Verbo, etc.
That's right. So why don't you take us into the first deal you've ever done?
Yeah, definitely. So my first deal ever was back in 2008, and this was actually back in New Jersey. So the interesting about this property was that I actually chose it because it was close proximity to my hospital. It was up in the East Coast. It was undervalued in a degentrified neighborhood. And I bought it actually for a long-term play because I was going to be up there long-term for my training. So I figured, put that money in a property as opposed to wasting it on rent. And so I did it. Purchase price was actually 115,000, with a 5% down payment. From there, the amount financed was approximately 95,000. We can talk about it was financed as the interest rates were coming down. So now interest rates are, about 0.5, less than 1%. This was financed back in 2008. So, the rates back then were like 7 or 8%, but I got a rate at 5.88%. So 30-year, 12 payments per year. And I can show you, so my initially without any renovations or anything, my gross monthly rent was $925 per month. And then, so that gave me basically a break even cash on cash return. So basically it was just break even with repairs and renovations. So new kitchen tiling, new bathroom, new flooring, with approximately 20,000, I was able to increase the gross rental income to $1,530. And that gave me, so that brought me from break even cash on cash return to an 8.2% cash on cash return. So, and I know we can go through the mechanics from there.
Yeah, let me just step in and ask. So it sounds like the mortgage was around 925. Is that correct?
You mean the mortgage? Yeah.
The total payment.
Yeah. So the thing is, with the amount paid to the bank, so principal plus interest is around 667, but then you also have to add in, for example, maintenance fees, insurance, taxes, etc. So usually, total expenses was around 925. So
okay. So when you say maintenance fees, are you saying HOA fees or are you saying like budget for maintenance?
HOA fees.
Okay, great. So yeah, so it was about break even before you put in the repairs. And then you were saying house hacking. Is this something that you were living in and then renting out rooms, or how were you doing it?
Yeah, so it was a 2-bedroom, 2-bathroom. And so I lived in one room and I rented out the other room and basically I put it, back then I was using Craigslist and using email as well. And from there I was renting out the other room and collecting rent that way.
So one room was renting for $925?
$925 before renovation.
Oh, okay. So then after you did the renovations, you put $20,000 in renovations, made it all pretty. You rented that same room for $1,530, or is this the whole place?
For that one room for $1,530.
Holy smokes.
Wow.
That's expensive in today's terms, never mind in 2008.
Yeah.
Yeah.
So, and my unique selling proposition was to market it to nurses, doctors, physicians, dentists that were working at the hospital. And I developed a good reputation as a good landlord, a trustworthy landlord, and always keeping things up to date. And so that allowed a better type of clientele that I was able to rent to.
So I have a question just about the climate of the time, because in 2008, I think I was still in college or something like that. So I wasn't in real estate, but I imagine there was a lot of fear. And I'm curious if it felt clear to you that there was nowhere that it could continue to fall, or if it was very up in the air and people were thinking, gosh, buying now is kind of dangerous because what if it continues to lose value? What was it like when you started?
So from my standpoint, to me, when I was starting out this career, I was thinking it was full of opportunity. So I looked at it from the lens of optimism, but there was still a lot of fear. So I did make, this was my first investment, so there was a lot of challenges that I learned from that I brought to my next series of investments. But back then I looked at it in terms of optimism. So and I always, I thought, real estate has always, if you take care of the property and you manage it well, it'll most often it appreciates in value. So it's the best time to buy real estate is yesterday. The next best time is today. So that was my thinking. I was thinking in terms of 20, 30 years down the road. And with that amount of fear, just people walking away, selling, that was my opportunity.
Yes, I'm curious. You mentioned some challenges. What are some challenges you experienced with this deal that you were able to kind of take in as experience to the next deal?
So I'll break it down into a couple of categories. First one was tenants. So I alluded to that this property was in a gentrified area. So this attracted a lot of bad tenants. So luckily I didn't have, the worst tenants, but I did have a lot of challenging tenants. So that was one thing. So how to do proper tenant screening, run a background check, run a credit check, how to interview tenants. The other issue I had was because it was in a less than ideal location, I had to learn how to market it better and how to make that property stand out, as opposed to people just overlooking that area. So that's one area. The second area especially was with just property management. So the property was built in 1984. So, had a, broken down AC, the kitchen tiling needed replacement, the wooden flooring needed repairs. So it had a lot of challenges in terms of me being able to increase the rent from $925 all the way up to $1,530. So that's why I put so much into the renovation. So if I could add that extra value and force appreciate it, then I could make it into a decent, respectable property. Then I could charge more for rent. So that was the second area, was in financing. How to fight your property taxes, how to get your property taxes down lower, negotiating with the bank, how to refinance your property. So all of these things, how to cut expenses. So initially with the, I would have tenants that just left the heater and AC on all day. So I learned how to push those costs back onto the tenants as opposed to me bearing that cost.
All right, Chris. So you're learning all these lessons at a kind of a crazy time, right? It's 2008. Bigger Pockets is around, but no one's really heard of it at this time. It's only Josh in his underwear in the basement, like coding or whatever. Brandon's not involved. And so there's no podcast. Like, how did you actually learn how to screen tenants, how to find a property manager, how to manage a property manager, right? There's no resources out there.
First thing was through real world experience. So I executed, and my idea was to my main goal was to generate cash flow, cash income. So as Robert Kiyosaki says, you want to make sure that the rent is paid, the check's coming, make sure you're paying your bills. So that was my main motto. And from there, a lot of challenges come up and you learn how to deal with them and manage them. So I'm always in a constant state of self-improvement. The other thing is, there's always the library, there was books. So that's how I mainly did it. There was also the internet as well. So back then, the main way of sharing information was through blogs. So blog was being very popularized, but main thing was through books. So, I would just go to the library, check out those books, read it, see what the key ideas, and write it down and implement it. So that's how I educated myself. And the other way I did it was through networking and through community. So finding like-minded individuals, going out with them, sharing knowledge, and exchanging value. So that's the other way.
Yeah, I just want to say, like, there's so many great ways to learn, right? Like, obviously, Bigger Pocket is an amazing resource. There's so many good resources out there. Like, I know the FI team has some good resources. Z's got great resources on Airbnbs, but like, the networking events and the people you meet are going to 100% trump anything you do. I think almost all the advice I've taken have been actually from people telling me. I love that, Chris. And so and obviously, like Chris just explained the deal where he was basically meeting the 1% rule while living in the property, right? Like that is not going to happen in today. So don't try and go and replicate what Chris did in 2008. He gets rewarded for being risky and doing something that no one else was doing in 2008. Right. And so, Chris, I commend you for that.
Thank you.
But why don't we get into like maybe the second, third? I know you did a house hack. It sounded like the first thing, even though the term house hacking didn't exist back then. What did the second one look like? And maybe talk to us about a burr that you did. Again, probably before the burr even existed.
Yeah. So my next deal this was actually an interesting deal as well. So after I quit my lucrative medical career, and I moved back from New Jersey back to Houston. So that, that original deal that we just talked about, that was fully rented, long-term lease. So this one here, I bought in the Houston area. And the beauty of the Houston area at that time was, so I'll give you an example. This property here, 1,000 square feet, 2-bedroom, 2-bath, and with, very decent condition, not run down or anything, you could buy for $70,000. And the rent for the 2-bed, 2-bath in itself in just decent condition, $1,500. So, and the reason why is I chose the Houston, Texas Medical Center. So this area is prime for students, for doctors, residents, dentists. It's all close to hospitals, scientists as well. So that's why I targeted, and it was the best time. So the funny thing is, okay, I go to the bank and I apply for a loan I wanted to put 20,000 down. So that at that time it was probably about $15,000 down payment. And the funny thing is I apply for a loan from the bank and they decline me. They say, oh, because too risky, you have one property. It was just right after, all these regulations. So I was like, okay, well, screw it. I was, so what happened was I reached out to friends and family, colleagues, and I raised the whole $70,000 for that unit. And I eventually paid them back within 1-2 years. So basically I paid it and then I basically refinanced the cash and paid back the investors. So that's what I did. That taught me a lot, that I didn't need the banks and that I could go out and there was alternative ways of raising funding. So let's go through. So this one here, this one was also a house hack because when I moved back down, I was living in one room, renting out the other room. So again, cash on cash return when I was living in it was break even. So basically all the expenses from that one room, which was a gross monthly rental income of $525, basically covered all of the expenses because it was a fully paid unit. So from there, so I house hacked it. After that, I got married 2 years later, so I moved out of it. And so basically that whole unit was generating a monthly cash flow of $1,250 fully paid. So that rose the cash on cash return to 9.2%. So, and I know you have questions. So
yeah. So this $70,000, you didn't actually put any of your own money into that. Is that right? And so you raised the entire thing?
Yeah, well, I personally I put $10,000 or $15,000 of my own money into it, and I went out and raised the rest. So that was through family, friends, colleagues.
So yeah, that is such a great way to build wealth if you can't get a bank loan, right? So some people don't have a W-2 job; they're just getting into their 1099 career. This is how you raise money. So like how did that conversation go with your friends and family, the same ones that were just crapping all over you for getting into real estate a couple of years back?
The best way to start out is through friends and family. So what I had going for me on my side was that the real estate market was really cheap, and so it wasn't like a huge risk. So a friend could pay $5,000, $10,000. They, the worst they could lose was 5,000, or, it wasn't something like, 200,000 or, something higher. So, and like I said, the best way to raise this money and funds is through friends and family. So there, you have a good relationship with them, you have a good rapport and trust. And the best thing about it is if you can demonstrate a good track record, they'll more likely to fund your next venture. So, I mentioned that after 2 years, I refinanced the property, paid back, my family and friends, and I used and they were able to loan me more funding for the next venture. So that's the best way. Again, I had the pricing on my side.
Right. So friends, I mean, I get it, right? Friends and family trust you, like certainly the most high conversion, but how do you even approach that conversation? Like, let's say I'm one of your family members, like come to me and tell me like, why should I give you money? Right.
It's tricky because you have to broach the subject in a way that's kind of tactful, because you don't want to feel like you're scammy, or you're trying to, borrow money and not return it. So, and you just, like you said, like sometimes you just approach it gently. Like my approach was, I would take them out to coffee or to lunch and just approach them and say, oh, the real estate market is this way, demonstrate a lot of knowledge about what's happening in the field, and talk about your track record, your successes. And some of them will, a lot of times, 9 times out of 10 they'll say no, which is fine. It's not, you're not always going to hit a home run and get a yes all the time. So my success rate with funding was usually between 5 and 10%, which is that's acceptable. So, and you just have to say, I'm raising money for this investment property. Are you interested? And go from there.
All right, Chris. So it sounds like, so the friends and family thing, again, I think it's a great way to do it. You approach it in a way where you just kind of tell them what you're doing, and hopefully they maybe even say, oh, hey, I'll give you some money, right? I got some extra money lying around. Like that's always the best way. So, it'd be best if they almost just tell you, hey, I've got the extra 5 or 10 grand. I'd love to give it to you and see what you can do with it. So, well, how did you structure this with your family and friends? Like, did you pay them interest only? Was it like a mortgage and you were just with a balloon? Like what was the structure of the debt?
So it depends on the individual, but so one was pay back lump sum, plus interest after 1 or 2 years. So that was the most common way. Other way is you can pay them a monthly. So for example, let's say you borrow $10,000. Back then the interest rate was 3%, 4% in 09, 010. So you amortize it. So every month they get a check. And the thing is, if you do it, they're more likely to say yes if you amortize it over a monthly period, as opposed to getting your lump sum back after 1 or 2 years. Some of it is also interest only. It all depends on what the conversation, but the variety of ways was interest only, could be balloon payment, could be monthly payments. And then also one way was you could give them the loan back plus whatever percentage of the profits that when you went to sell the property.
Gotcha.
I'm just curious here about like the complication involved, right? Because it sounds like $70,000. Yes, you put in 10 yourself. Maybe you need some of that for closing costs, but then do you have like 10 people in the deal? Some of them you're paying back monthly. I totally get that when we're starting, it's about the hustle and the making it happen. So maybe you don't do this stuff anymore, but did you find that it was a little bit like cumbersome with bookkeeping and all that stuff?
Yeah, you have to be really detail oriented. You have to be really organized. Excel back then was what I used. Now it's Google spreadsheets. But like I said, I spend a minimum of an hour or 2 every day on my finances. So I'm looking at the numbers. So I'm naturally organized and detailed. But if you're ever taking money from investors outside, you have to be very meticulous. You have to be really honest in your dealings in order for you to be successful. Because if you develop a bad reputation where you don't pay back investors, that's going to haunt and bite you back in the ass in the future.
Okay. So you bought this thing for 70 grand. Did you do any rehab to it?
Yeah. So this one here, I actually put in it was carpet flooring. So I changed that and just put in some wooden flooring. The reason why I like wooden flooring is because it's easier to clean and you don't have to replace it as much. So you don't have to, one renovation repair, sets you up for, 10, 15, 20 years. So this one I only had to put 1,500 in repairs renovation, fixed up a little bit of the bathtub tiling, some new cabinets, made it a little bit more respectable and decent. So I put in 1,500. Still, like I said, originally when I was house hacking it, it was 500 per month for that single room. And I was able to increase the rents to about 625 per month after the rehab and the renovations and the repairs.
Okay, so you bought it for 70K, you put 1,500 into it, and that, did you do that work yourself, or how did you get it for so cheap? It seemed, that feels really cheap.
Yeah, that's another advantage of living in a low cost of area living. So back then, back in Houston, the cost of the materials, the labor and everything was really, really inexpensive. So that's why I was able to make such a great profit. Now these days, you may not get such a good deal.
All right, Chris. So 15. So I think that is like just a testament of the times, right? Because in 2008, no one was buying houses, especially flips. So contractors were like super out of work. So they'll do anything possible to get a job, and $1,500 to them back then was probably like, oh yes, I got a $1,500 job. So again, nature of the times. These days, burrs don't work as easily because contractors are very, very busy, and they don't need they don't need that extra work. And so $70,000 down, $1,500 in rehab. Did you ever get that thing refinanced or reappraised?
Yes. So I did refinance it. So I did a cash out refinance. So I took out, so back then the property, so I did a cash out refi in 2013 and I bought the place in 2009. So back then the property had appreciated from 70,000 all the way to 100,000. So I was able to pull out that 70,000 and get my money back and pay back my friends and family. So that's what I did. And now it's sitting at a 3% interest rate. I didn't refinance it, even though the Fed kept dropping the interest rates.
Okay.
I think a cool thing to tell people about refinances, because sometimes they can be predatory and a little bit of a trap. So I'm not always a big fan of them, but a cool thing for people to know is that you can get a free refinance, and it doesn't actually have to go through your same lender either. And so the reason for that is that if you're doing one of the current interest rate, well, they usually won't give you the best of the best, but you can do one that's a little bit higher. So say the best interest rate you could get right now is 3%, but they might give you 3.2 for free. And so then you're not paying that $3,000 to $5,000 a month in closing costs and everything. And loans have a lot of money built into them. We don't really see that. So the loan officer is still getting paid. You don't have to feel bad for them, but it's a great thing to know about. And it's not necessarily the same for cash out refis. Those are a little more expensive, but if you're really looking to lower your interest rate, this is just a cool trick to know about.
It's great that you mentioned that, because, if you really shop around for rates and lenders, and you can really cut your costs and save a lot of money.
Okay. So yeah. So Chris, it sounds like you got into real estate investing kind of back before it was cool, 2008, 2009. You did the house hack before it was cool. You did the burr before it was cool. You were just like cool before it was cool, being cool. So why don't we kind of like jump ahead a little bit, right? We're kind of coming towards the end here. And so I know you mentioned you're basically investing in real estate every year from 2008 to 2016, right? So that's 8 years. Were you kind of just doing the same strategy and building a portfolio? Like where did your portfolio lie in 2016?
So 2016, I had 8 properties and all of them using the same strategy. The burr method, house hacking, short-term rentals, and Airbnb from 2013 to 2016. That's when it was in vogue. So from that 10 unit portfolio, I did the same thing. I focused on single family condos, focused on medical students, medical professionals. That was my strategy. And there's a lot of different strategies. So, there's short-term rentals, there's commercial real estate, there's real estate syndicates, there's development. So really my advice is to focus on, just a cookie cutter, simple approach that you can just take action on. And real estate is interesting because real estate building wealth takes time and it's extremely slow. So if you're interested in getting rich quick, real estate, the way you can generate cash flow quickly through real estate is either through being an agent, or you're raising funds, commercial real estate, or you're a developer. But building wealth through landlordship takes time it takes a lot of work.
Yeah, I'm glad that you mentioned the piece about becoming an agent, because it's true that sometimes to combine with being an investor, doing something like being an agent is a great opportunity because of the cash flow, right? It's an active business that can be part-time and can be really lucrative, and you can be really smart with it and pour money back into buying rentals, because you really get an opportunity to see the market and see a lot of homes coming in and out and get an idea of like what is a good deal and what's not. So, Craig and I are both agents, but I definitely think that it is a really cool opportunity, even for a little while you're building your portfolio.
So
Exactly.
Chris, where were you at on like how much passive income did you have in 2016? Because that's when it sounds like you made your switch.
From real estate, my passive income was approximately 10,000 per month. So
Okay.
yeah.
So that seems to be the number that a lot of people kind of shoot for. So you hit your goal at $10,000 per month. Then what happened?
So from there, I had my net portfolio, was a millionaire, had passive income of 10,000 per month. So from there, my idea was to grow, reach, and scale. So I also was very frugal. I saved a lot. I had a high savings rate, and I invested a lot.
So when you said did you hit a millionaire in 2016 with $10,000 of passive income?
Yes, that is correct. Yeah.
So, okay, I want to touch on that for a second, because there's this thing called that I like to look at, which is like your passive income to your net worth ratio, right? And so you had an extremely high ratio, right? Like basically 10,000 times 12 months is $120,000 a year, while having $1 million net worth. That's basically like saying, instead of the 4% rule, I'm going to use the 12% rule, right? And so that is incredible. And I just want to point out that like, that's what real estate can do, right? Like, I know everyone talks about the 4% rule, super safe and all that, but real estate, look, you just did the 12% rule, basically $120,000 a year. And that's got inflation baked in, because with inflation increasing, rents are going to increase, your property values are going to increase, all that's good stuff. So I just wanted to make that point. So congratulations on becoming a millionaire in 2016, and congratulations on you hitting your goal of $10,000.
I just want to say that it's really impressive, because getting to $10,000 in that short period of time, and also just through real estate, can be like hard to do. I'm very curious, like, Craig, do you know off the top of your head what your cash flow is on the properties that you own?
I can give you a rough estimate. And so I probably have, just on my rental properties, it's probably around 7,000 or 8,000, right? And so
yeah. So you're not there either.
No, so I'm not with my rental properties. And so I'm less efficient, right, than you were in 2016, for sure.
Totally. And I think even for myself, I'm probably around 6,000 or something like that. And I have been selling some properties to trade up for short-term rentals, but short-term rentals are not consistent, right? So it is important to have a variety there, because in the slow season, you're not going to be making that really exciting cash flow that you might be making in the high season.
Exactly.
Yep.
Great, Chris. I'm impressed.
So 2016, it sounds like you kind of moved away from real estate in 2016, and you said you went into stocks. So what was your thought process there? Why did you do that? How did you do that?
So one of my rationale was, I had made my first million in real estate, and I wanted to make my next million through another strategy. So, and equities was the easiest way to get into. I also wanted to have a more passive approach to building wealth, as opposed to buying and managing houses and rentals and tenants. I wanted something more I wanted to focus on building my paper assets. So that's my main strategy. And I also wanted to, back then, the bull market was from 2009 to 2021. So the house hacking really helped me to save a lot of money, and whatever savings I made through house hacking, I had a high savings, and I poured it into the equity market. So that was when the bull market was still underway.
So you were still house hacking at this time, right? You didn't sell your real estate. You just held on to it and decided you weren't going to buy anymore.
My strategy was to just buy and hold real estate, and keep my expenses low, have a high savings rate, and build my portfolio and my net worth.
I love that. So what did you use so you're saving from you got $10,000 a month of passive income from your properties. You're not working at this time, right? You're just or are you working?
Well, I was doing consulting, so I did have some earned income that was as a physician and as a consultant with different hospitals and businesses, but that was just more of a side hustle, and that was just side income and just having an earned income. But my main focus and my main goal was through investments and through business.
Okay, makes sense. So you basically putting all your money into, I take it as an index fund. Is that right?
Initially, I was doing it through index funds, but later on, because I understood the market a little bit better, I started choosing individual companies. So the safest way, if you're interested in equities, is to get into just save 20% of your earned income or whatever your portfolio, your passive income. Take that 20% and put it into a low cost index fund, and you dollar cost average it over 30, 40, 50 years. You're bound to reap your rewards. So that was my initial strategy. Once I started to feel more comfortable in choosing companies and looking at companies and looking at where trends were going, I was more comfortable in investing in individual companies.
Got it. Awesome. So just a quick recap, Chris. So basically, you found out about financial independence in 2002. You got your doctor. You were a doctor from 2002 to 2008. You said, screw this, I want to go into real estate. 2008 to 2016 was real estate. Once you got back, actually after 2016, you stopped expanding your real estate. You hit your goal of $10,000 a month. Then you just basically started systematically buying index funds and then eventually stocks once you felt more comfortable. And so where do you lie now today in 2021?
Yeah. So now what I'm doing is I've built my influencer audience. So I've written 4 books. I've spoken on numerous financial conferences, high level conferences targeting high net worth individuals. I'm an author. I've also started, the Financial Freedom for Physicians blog, podcast, YouTube channel. And it's mainly my mission is to spread awareness, spread the word about the importance of starting financial literacy early, start saving early, start investing early, so that, when you're in your 20s and your 30s, you can be more financially free.
I love that. I love that. Love that. Love that. All right, Chris. So we are heading to the end of our show. You've got an amazing story. Before we head to the final 4, is there any parting words of wisdom you want to say to our listeners?
Well, I've really appreciated the time on the podcast. It's really the first time, I've able to share really specific detailed numbers, share my strategy and vision of where I'm going. And, you can always reach out to me. I'm at, my website is www.drchrisloo.mdphd.com. And I'm happy to answer your questions.
The final 4.
What are you reading right now? It seems like you were reading a lot at the beginning.
What was interesting is I just recently finished a book called How the Internet Happened, and it's a fantastic book. I'm really a connoisseur of history, especially when it comes to economics, history, business, finance, and how technology and how it all intertwines. So it really talks about like the early stages of the internet, from the early TCP IP protocols all the way to email, to search, smartphone, social media, and now it's now where we're headed is towards blockchain, artificial intelligence, NFTs, crypto, etc. So it's a fantastic book if anybody loves history.
Cool.
Awesome.
Thanks.
What is the best piece of advice you've ever received?
Best piece of advice is really your finances are extremely important. So growing up, a lot of my friends and colleagues got the message that finances are not important, and they are really important. So you really it's almost like going to the gym and working out and developing your health. You have to really work on, study and learn and work on your financial health. So that's one of the best pieces of advice. If you have your financial health, your freedom, your independence, you're that much better.
I love that. Yeah, no one is going to help you financially like you would yourself, right? Like, sure, you can hire financial managers and stuff, but they don't have your best interest in mind. They always have their own best interest in mind. So love that.
All right, Chris, what would you say is your why for doing what you do?
My why is to really spread my mindset and my motivation for financial freedom. So if I can get the word out that financial freedom is much different than having a job or job security and stability, and really open people's eyes to the idea that the world is changing and where we're going in the next 20 or 30 years is going to be radically different from the last 30, 40 years. So that's really, I'm trying to get on these podcasts, share my story, and really just put the content out there, get people aware that there's, you have to start working and building your financial literacy and your independence.
All right, Chris,
Awesome.
last semi-serious question. You seem like a smart guy. Have you ever been caught cheating on a test?
No, I have not.
Have you ever cheated on a test and didn't get caught?
No, I've never cheated on a test.
Really?
No.
Oh man. Z, have you cheated on a test?
Totally. I don't know. Maybe
feel like
it's
I've-
cultural.
Yeah, I feel like I've cheated on more tests than I haven't cheated on.
Oh my God. Well, I'm not that bad, Craig.
I'm just kidding. I don't know. They're just reminders. They're not really, right? Chris, you're a good man. Okay, Chris, you mentioned it before, but where can people find out more about you?
Reach out to me on social media. I'm on LinkedIn. You can type in Christopher Loo. Go to my website, drchrisloo.mdphd.com. You can search YouTube Financial Freedom for Physicians podcast, or Spotify and Apple, or you can reach me at Christopher Loo mdphd@gmail.com.
Awesome. Chris, thanks so much for coming on the show, shedding financial freedom to physicians nationwide. We love it. Again, thanks so much for coming on, and we'll talk to you soon.
All right. Thanks so much.
See you now.
Thank you.
And that was Chris Loo. Z, what'd you think of Chris?
I thought it was a really great story. I love how he was like, I'm going to make my first million in real estate and hit my goal there. Then I'm going to make, I assume, another million through index funds or investing in companies. And then he's turned around and said, like, now I'm going to just put all this like direction and clarity and organization. I was very impressed with how organized he was, into giving back. So he's going back to his community where he started at Physicians and teaching them all about financial independence and real estate. And I just love seeing that. So I thought it was really great.
Yeah, I thought he's got an incredible story. He's extremely efficient with his like cash flow to net worth ratio. Like I think I mentioned in the episode, 12%, like that's really high. So amazing for him. Again, I wouldn't expect to get there in these times. He bought at great cash flowing times, right? And so kudos to him. And yeah, I just love his story, from real estate to stocks to now giving back and building a brand. And you can tell that he was a hustler at first. And then obviously it's no secret that stocks are a lot more passive than real estate is. And he decided not to grow his real estate portfolio even more, even though I'm sure he could. And it's a bug and it's addicting. He's like, no, I'm done with that. I'm going to go into stocks, so then I could focus on building my own brand and focus his time there. So just love that. Love his story.
Yeah, I think it can be distracting with real estate, because even if you say, well, I'm going to take the portfolio I have and improve it, which is something I've been doing lately, selling the cheaper homes and putting more money into bigger homes and having less of that, it is time consuming and there are costs associated with it. So sometimes being just a buy and hold investor and saying, I hit the number of properties I want and the cash flow I want and I'm done, there's something to that. So I think he's pretty crafty.
For sure. And your cash flow like will go up over time. I'm sure it's not still 10,000. Like over the last 5 years, I'm sure rents have gone up. Mortgage payment stays the same, right? Maybe your taxes and insurance increase a little bit, but not as much as the rents. So,
Yeah.
So yeah, I don't know. I again, just huge fans of real estate for many reasons. Z, you want to take us out of here?
All right, guys. Well, thanks so much for listening. We're here every week. And if you love this episode, please share it with your friends and family. You can always leave us a comment, rating, a review, in Apple, iTunes, Spotify, all the things that you listen from. And yeah, we'll see you next week. Thanks for listening.
That's it for this episode of Investify. We hope that these nuggets of real estate wisdom lead to more savvy financial planning and a clearer path towards financial freedom. For more content like this, subscribe to the show at investify.com. Don't forget to leave a rating and share it with your friends. Together, we can transform more real estate newbies into successful and clever investors. Thank you so much for listening. See you on the next one.